If every nation on Earth is in debt, who collects the money? The United States owes tens of trillions of dollars. Japan owes more than its entire economy produces in a year. Europe, China, Germany, Saudi Arabia, Britain, France, even the richest countries on Earth all carry enormous debts. So the question sounds almost absurd. If everyone owes money, who is standing on the other side? Who is the creditor? At first, it feels like there must be one giant hidden lender behind the curtain. A country, a bank, a group of billionaires, some secret institution collecting interest from the entire planet. But the truth is stranger than that. The world does not owe money to one person. It does not owe money to one country. It mostly owes money to itself. But that does not mean the system is fair. Because debt is not just a number. It is not just a burden governments carry on a spreadsheet. Debt is one of the main structures holding the modern world together. It funds wars. It builds empires. It saves banks. It supports currencies. It fills retirement accounts. It moves power from the future into the present. And to understand why almost every country is in debt, we have to go back to a time before credit cards, central banks, and digital money. We have to go back to war. In the late 17th century, England was fighting France. War was expensive. Gold was limited. Taxes came too slowly. The king needed money now, not years later. So the state turned to wealthy merchants and financiers. The deal was simple, but powerful. Lend money to the government today. In return, the government will pay you interest tomorrow, backed by future taxes. To manage this new system, the Bank of England was created in 1694. This was not just the creation of a bank. It was the creation of a new kind of power. The state could now spend money before it had collected it, and lenders received something more useful than gold. They received a government promise, a promise that could be bought, sold, traded, passed from one investor to another. That promise became the government bond, and the bond became one of the most important financial inventions in history. Before this, empires needed treasure. After this, they needed credibility. A ruler who could borrow could fight longer wars, build larger fleets, expand faster, survive crises that would have destroyed poorer states. Debt stopped being only a sign of weakness. It became a sign that markets trusted you. The ability to borrow became the ability to rule. Over time, this idea spread. France used it. The Netherlands improved it. The United States used debt to fund its revolution, its expansion, its wars, and eventually its rise as the center of global finance. By the modern era, national debt was no longer an emergency tool. It had become normal. Every major government issued bonds. Banks bought them. Pension funds held them. Central banks used them. Foreign countries stored them as reserves. Debt became the language of the modern state. So when people ask, who owns government debt? The answer is not simple. Take the United States. People often say America is in debt to China. That is partly true. China does own a large amount of US government debt, but it is not the whole story. A huge share of US debt is owned inside the United States itself. Banks own it. Mutual funds own it. Insurance companies own it. Pension funds own it. Individual investors own it. The Federal Reserve owns it. Even government trust funds own parts of it. So when the US government pays interest, that money does not simply leave the country and disappear. Some of it flows into retirement accounts. Some of it goes to banks. Some goes to foreign central banks. Some goes to investment funds. Some goes back into the financial system that created the demand for the debt in the first place. It is not a straight line. It is a loop. The government borrows. Investors lend. Taxpayers pay interest. Financial institutions collect it. Those institutions buy more bonds. And the cycle begins again. This is why government debt is so hard to understand. The debtor and the creditor are often part of the same machine. And that machine is not only American. Japan owns U.S. Treasury bonds. The United States helps fund global institutions. European banks lend across borders. Developing countries borrow from international lenders. Then many of those same countries store their reserves in the bonds of richer nations. Money moves in circles. Promises back other promises. One country's debt becomes another country's asset. On paper, the world looks like it is drowning in debt. But inside the system, that debt is also someone else's savings. A government bond is a liability for the state. But for the investor holding it, it is an asset. For a pension fund, it is safety. For a bank, it is collateral. For a central bank, it is a tool. For a foreign government, it is a reserve. For the global market, it is one of the foundations of trust. This is the paradox. The world complains about debt. But the world also depends on it. And behind this entire structure stands one of the most powerful forces in modern history: the bond market. The bond market decides how expensive it is for a country to borrow. A trusted country can borrow cheaply. A fragile country must pay more. A country that loses market confidence can be punished overnight. Its currency can fall. Its interest rates can spike. Its government can be forced into cuts, reforms, or rescue deals. Elections decide who gets power, but markets decide how much that power costs. And above the market stand the central banks, the Federal Reserve, the European Central Bank, the Bank of Japan, the Bank of England. Central banks do not only watch the debt system, they help run it. When a central bank buys government bonds, it creates new money and gives it to the financial system in exchange for those bonds. One balance sheet expands, another receives liquidity. The bond becomes money-like. The debt becomes a tool of policy. This is one reason modern money feels so strange. Money is no longer simply coins, gold, or paper. Most money today is created through credit, through loans, through deposits, through central bank operations, through promises that are accepted as valuable because the system believes they will keep working. In a modern financial system, debt and money are not opposites. They are deeply connected. But the system has one weakness: confidence. As long as investors believe a government can keep paying interest, the machine continues. The debt does not need to disappear. It only needs to be serviced. But when confidence breaks, the creditor suddenly becomes visible. Greece saw this during the debt crisis. Bond investors lost faith. Borrowing costs exploded. The European Central Bank and the IMF stepped in. But the rescue came with pain. Spending cuts, higher taxes, unemployment, austerity. Argentina has lived through repeated defaults, where debt became a national wound, reopened again and again. Sri Lanka faced fuel shortages, social unrest, and political collapse after running out of foreign currency to service its obligations. In good times, debt feels invisible. In bad times, the creditors appear at the door. And yet, after every crisis, the system usually restarts. Old debt is restructured. New debt is issued. Emergency loans replace previous loans. Interest rates change. Deadlines move. The name changes. The balance sheet survives. That is because modern sovereign debt is not really designed to be paid off completely. It is designed to be rolled over. A household loan is supposed to end. You borrow money. You make payments. Eventually, the debt should disappear. Governments do not work that way. They issue new bonds to pay old bonds. They refinance. They extend maturities. They manage interest costs. They keep the system moving. The point is not to reach zero. The point is to remain trusted. This is why the world does not simply want government debt to vanish. Banks use it as safety. Pension funds use it for stability. Investors use it as collateral. Central banks use it as a tool. Foreign governments use it as reserves. Debt becomes a heartbeat. It moves through mortgages, pensions, banks, savings accounts, foreign reserves, and financial markets. It is the invisible rhythm beneath modern capitalism. But there is a darker side. When people say, "We owe it to ourselves," they are only telling half the story. Because not everyone owns the debt equally. Interest payments tend to flow from taxpayers to bondholders, from workers to asset owners, from the public budget to financial institutions. So debt is not only a transfer between countries, it can also be a transfer between classes. At the top of the global debt pyramid, there is no single face. It is not just China. It is not just Wall Street. It is not just the IMF. It is not just central banks. It is not just governments. It is all of them. And in some way, it is us too. Modern finance has turned debt into the foundation of money itself. Governments issue it. Banks multiply it. Investors trade it. Central banks manage it. Citizens depend on it. Once, debt meant bondage. Today, debt means balance. A balance between trust and fear. Between spending today and paying tomorrow. Between public power and private capital. Between growth and collapse. And if that balance breaks, debt becomes what it always was underneath. A promise. A promise made by the present. To be paid by the future. And no promise can stretch forever. If you want to understand the hidden history of money, power, debt, and empires, subscribe to the Money Timeline. Because history has the answers. You just have to know where to look.